Ryan, well, good to have you, man. Last time I saw you, we were both in Guatemala.
Correcto mundo. What a beautiful place.
It was beautiful, right? That whole old city, and it was a fun event. Great folks there that we were able to connect with, and I know you brought a lot of your portfolio companies. You invited them as well, right? At that event.
Yeah, we had about 18 founders.
That's awesome. It's great to get everyone together, get all those people together, and I want to dive into a bunch of stuff with you, and that could be a good segue into just like community, because you started a community back in 2008. But before that, let's just double click a little bit more on your background. Before starting K50, you founded a couple companies. Worked at another company. You had an accelerator, Momentum, and the venture studio Kairos. How did those experiences help you become a better investor in startups? If you could just, share a little bit more.
Yeah, totally. Yeah, so I was a founder coming out of school, and that's actually where my paths originally crossed with the community. My friend and friend of friend was creating Kairos, and Kairos was built to be a community to focus the next generation of founders on really solving problems that matter. We grew from just in the US to over 39 countries. And we saw some incredible founders in the community raise billions of dollars in venture capital, really 5 billion plus, with companies like Brex and Oil Rooms and Freenome and FiscalNote and Casper kind of leading the charge there. I met a lot of those guys in the beginning, when I was coming out of school. They were creating a company too. And I think every experience up into the point where we started the venture platform for, which is now K50 Ventures, which is what I run, and my partners run a venture studio called Kairos HQ, really helped kind of lead me to create what we've done so far, which is like a first check investment firm. And I can share more about that. I'm sure you're going to ask a few more questions there. And a community where founders would get really true value out of at the very earliest stage. So as a founder, I have empathy for other founders that are out there creating companies. I know how hard it is. I've had success. I've had like complete failure. And then I've also learned what it takes to scale, from a few of the companies I worked with. JumpTap, we did quite well. We ended up selling to a group called Millennial Media, for about $500 million. I was very close with the founding team there, although I was just an employee. And at Bloomberg Capital, I was lucky enough to be on the ground floor of some incredible companies. We were seed investors. So Bloomberg is $1 billion under management. I worked with the three partners there at the time, and really working with David, probably the most, David Blumberg, and saw companies at seed that went off to go an IPO. 3 companies, in fact, that we invested in at seed while I was there that ended up IPOing: Double Verify, Braze, and Nutanix, and got to see what it takes to create that culture, that initial team, and how an idea and a mission can turn into multiple different products, and 5,000 plus employees, IPOing. Pretty incredible to see that and see it go from idea to IPO. I think all that has really helped me understand how to be helpful to founders, how to be empathetic to founders in the very beginning, and really how to be there. Like I always call it like a sixth man, for like a basketball term, of being that person that's on the team that's on the bench that can help and come in and help out where necessary at the very, very beginning, and really kind of roll up our sleeves and help these companies, which I think every founder really needs at the very beginning of their journey.
Yeah, let's talk about that a little bit, because one of the things that's difficult for a lot of investors is, that elusive product market fit stage, right? Where, you come in really early, and there's only so much you can do as an investor in the beginning, because until the company's really, figured out those critical pieces that are going to enable the company to scale. You mentioned 3 companies that at seed, they ended up IPOing. At that early stage, was it really clear that there was product market fit for those companies? And how do you jump in as a six man when those companies are still teetering on figuring out really what their customers need and what's going to be the X factor for them scaling and becoming a big company?
Yeah. So by and large, the 3 companies that I mentioned, and I would say any of the companies that are in our portfolio that we invested even at pre-seed and are now worth $1 billion plus, there was no product market fit. I would say that it was very, very early, because we truly are first check investors. Some of the companies will invest in seed, but for the most part, you're seeing the kind of you're either meeting them before they actually create a product, or with very little data, and it's really so it's really truly that early. I think the thing that was constant across every single company that I've seen that have done well, and have created beautiful products that have scaled and now have on their second or third product within their company. It's all about the team. And for us, we really are digging into that problem founder fit. So the team that's the right team to go out and solve the problem that they're trying to solve. For instance, the 3 companies I mentioned at Bloomberg, and this is very different than the types of companies that we're investing in today at K50. These were all very technical problems. The Nutanix team was going out there and creating a product for a technical problem that existed in large technical companies, because they did it at Google. So they had built this product at Google and were basically spinning out of Google to go and build this product and offer it as a solution for many different companies, whether they were tech or for the technical departments of Fortune 500 companies. They were the right founder to go out and solve that particular problem, and they had done it before. When we're talking about a company, for instance, and I'll talk about a company in Latin America because it makes the most sense for the listeners. Let's say Frubana. Frubana was founded by a great founding team and headed by Fabian Gomez, who's before was a country leader at Rappi, and knew what it took to build a marketplace from zero, because he had gone out and been the GM for different countries that Rappi was expanding into. And this was back in 2016, 2017. He was at McKinsey before, and he knew what it took to build a marketplace from scratch, which is typically the hardest part, to build a particular marketplace. And the marketplace that he was building for were different restaurants that needed access to fresh, quality ingredients at great prices. And so it was a a problem that he knew pretty intimately. It was a mission that he's consistently tried to drive towards, which is really helping out the mom and pop shop, which is what he really liked at Rappi. And he knew these restaurants very well. Very different problem that Rappi was solving for these restaurants, which was more on the demand side. But what he learned was that a lot of these restaurants had these big problems that existed in their supply chain. So Fabian was the perfect person to go out and solve that. No one was doing it at the time. There was a couple of companies that were doing it in India and China and the US, and he had studied those models. And so for us, this was before Y Combinator, for us to put a check into Frubana, into that type of founder, made a lot of sense for us. And so I think those are the types of teams that we're trying to invest and bet on. And that is most of what we do, is finding founders that are trying to go out and solve a particular problem that they're super passionate about, that they have experience with. The leap, right, for us as an early stage investor, and I would say this for any angel investor that's out there that's investing, whether it's 5, 10K to 100K into a company before they've actually created a product, is can you see this founder? Do you believe in the problem that they're solving in the market opportunity? Is it big enough? And then do you believe that the next step of what they're going to need to prove was that there is an actual problem that exists? Like if you can already prove that in one meeting with the founder, you basically have underwrote that these guys can easily get to their next round of capital, because all they're going to have to prove with their next round of capital is that they can build a little bit of technology and can actually deliver the product. And you've already proven that the large, outsized opportunity exists. So it's really execution at that point. And if you can do that if you can make enough investments, you can diversify a lot of your risk out. And so really what you're betting on is execution. All the other stuff about the problem exists, the opportunity is huge, and the founder is the right fit. If you can prove those three things, I think you've really kind of underwritten most of the risk out of being an angel investor. And that's what we do at scale and as an institutional fund.
Yeah, Francho, I remember. I recall that he had some kind of also particular insight from his family and the business or something. I can't remember, but I remember meeting
farming.
Farming, yeah. So they had a farming background
in agriculture. So he knew the supply chain and how fragmented it was, and then he, being the McKinsey guy, made it really clear to investors the waterfall of the different prices, and you could see that clearly you can make up 20 to 30% of all this spend that these restaurants are spending is garbage. It's all middlemen and just expense and exhaust that now that they've capitalized on. And they started off in Colombia, they expanded to Mexico, but their biggest market now is Brazil. So
yeah, it's one of those deals where Simon from Rappi told me about it. I'm like, hey, what's a good company? And he told me about it. And I was light on liquidity at the time, and I didn't have enough cash. But I met with Francho, and I was like, oh, this seems like a really, and I couldn't scrape together the money, probably invest in the round that you invested in. I think that they didn't have anyone on their cap table yet, and they were just raising their initial capital. So unfortunately, I missed out on that one, but very impressive what he's been able to build, and congrats. I think it's going to end up becoming a great investment for K50. Let's talk a little bit more about, K50. It's evolved into this venture capital firm, but from what I understand, it's actually a continuation of the K50 community, which started, I don't know, back in 2008, if my research is correct. And is that correct?
Yeah, totally. So we started the community back in 2008. Again, as I mentioned before, to focus really the next generation of founders. So who are going to be the next Mark Zuckerbergs on solving problems that matter. So solving real problems for real people around the world. We grew from just being in the U.S. To over 39 countries, and we saw thousands of founders come through the community and raise $5 billion plus in venture capital. Kind of the common theme or thread that we saw with founders. So in 2016, we said, okay, we need to turn this into a venture fund. Like, first of all, it's really hard business to keep a community up and running, as you know. And if and the monetization layer ends up being, funding. But what we realized was we had the track record and really kind of this huge community. So we knew the startup venture ecosystem. We had the track record of curating and really a process of curating a small group of founders or 50 companies. Every year we would invite 50 companies to come and present at our summit. And then over the year we would help develop an even larger community to really help kind of get them ready to at the end of the year for the summit to be able to get into the summit to present as a K50 company. And we would invite all these really great press and investors and kind of business leaders of today. And what we realized is like every single one of those founders, they had a tough time raising their first fund and even raising their first initial capital. And I think any founder would say that the first couple rounds of capital are always super hard. You're having to go to your friends and family. And then now that there's actual pre-seed, you typically don't have to have a rich uncle or a rich father, mom, or someone in your family that has made a lot of money. So it has democratized entrepreneurship, which has been really great. But even today, especially in emerging markets, it's still very limited in terms of the folks that you can go to raise money. And I think what you guys are doing is absolutely incredible and plays into this a lot, which is like giving them an access point to be able to get in front of a lot more VCs. But I think you and I both know that and it's funny because like I've been in communities for venture managers as well, and I always go in thinking I want to raise capital, but the biggest value that comes out of it is the community that you meet of founders and that camaraderie that you have of starting a company with another person in that cohort. And for somebody to say, I went through Latitude 12, I don't even know how many you've done to this point, but I at some point it'll be, I went to Latitude 199, and the guy that went through the Latitude number 1 is helping that founder go through and solve some of these particular challenges. And so we felt like, our edge is going to be, we know how to build community. We'll continue to double down on it. And, we'll also bring all of this community that we had created from 2008 all the way to now, to really help founders get an edge when it comes to just not making the same dumb mistakes that other founders have made in their past. And I think that's what we do, right? As venture investors, we help them not make mistakes. We help troubleshoot mistakes before they occur. And the community really helps do that, drives value, builds network. It's also freaking lonely building a company. As a single founder, it's extremely lonely. Even when you have a couple of co-founders, it's still lonely. For the CEO, for the CTO, they're both doing their own thing. It's good to have other people that have done it before that you can talk to. And the community really helps drive that. And I'm sure you've seen this at Latitude.
Absolutely. The thing that is interesting for me about this is that, community is kind of buzzy right now, and it's been buzzy, last couple of years. It's become more of something that's more talked about. But you started in 2008. And so what was the insight? I mean, the reason why we started Latitude is because that it's kind of the community I wish I had when I started, which, I think that all the founders of Latitude feel like the importance of having that support network. But in 2008, this is we're talking about a decade and a half ago. Was there any other particular insight? And was there an idea of what the community would evolve to? Because there's one thing that Sahil Lavingia says. He joined an angel session, and he said, first you build the community, then you listen to the community, then you solve problems for the community. Did you have that awareness when you started solving a community or creating a community? Was there something that that you thought it would become, or was it just because of something you wanted to kind of support and give back?
So really, truly, we started the community to do two things. One, support the next generation of founders, which included us. So we were building the community for us. And two, we had this idea of what if the leaders of today were friends 20, 30 years ago? What problems could they have solved, and how would the world look differently? So those two things, I think, really helped us develop a really incredible community that people wanted to be a part of this mission to really solve some of the world's biggest problems. As we continued to build the community, we realized that the community itself had all of these different problems that they wanted solved for them. So to get to your point, which is, what were the different insights that we had learned? The biggest insight that we had learned throughout the 8 years was mentorship for both the mentee and the mentor was so important. And again, I mentioned this before, like, I think a lot of people came into the community thinking, at one point, a lot of people were coming into the community that hadn't started a company yet, or just had an idea. And so they were really hoping to develop their idea and find co-founders. Anybody with the company was really looking, for the most part, they're looking for customers, they're looking for investors. And of course we tried to make that a part of the programming, for them to really meet their first for them to meet their co-founders, for them to meet their first customers, and for them to meet their first investors. But the thing that I think came out of it that was so important to me, and what we really tried to double down on with K50 Ventures is the relationship between the founders themselves and creating that mentor and mentee relationship, which we do a lot of. We do one-on-ones. We have different groups for very particular types of businesses. For instance, we have a learning group for verticalized healthcare companies. And you have a verticalized healthcare company in Brazil. You have a verticalized healthcare company in the US. You have one that's doing something for women over 40. You have something doing something for COPD patients, and they can really learn from each other. And it really builds those bonds and experiences. And so we do a lot of kind of anything that we can do to build a better bond and experience between the founders. It basically takes out the need for the partner to be the main driving value add for the founder, which I think I have a lot of experience in building companies and investing in companies at the very early stage. But to say that I can support, 50 companies is ridiculous. And I think that's the problem that a lot of funds face as they grow up and their experience gets, more better and better from the founders, and the portfolio gets bigger and bigger, and the funds that they raise get bigger and bigger. It's very difficult for them to keep focusing on the investing into early stage founders. And I think for us, what we wanted to do and is really build a platform that could help scale as we grew, because we typically, like, funds want to stay very early, or sorry, they want to stay early. but then they end up raising a bunch of money and continue to invest bigger dollars into companies at later stages. And that's because they can't really focus on the early stage anymore. And so what we've tried to build from the get-go is a platform and a model that helps these founders at the early stage at scale. And the only thing that can do that is community. So like Sahil said, we built community way before we built the fund. We were building it for 8 years, learning everything that we could about that community. But really, it was the power in numbers and the alignment of the different founders that then helped us build the fund. And we will continue to add value to these founders at scale, really through our portfolio companies, whether we're writing a $50K check or $1 million check.
So would you describe it as like a decentralized support system for founders? It's the exact opposite of what an Andreessen would be, which is like a CAA, verticalized support for very specific things. Is it going in the opposite direction where you just your community and your portfolio ends up becoming the support system for the rest of the portfolio? Is that the way you would describe it?
That is 100% the way we're going. And when we do some programming for certain things, for instance, fundraising and PR for right now, and like telling your story and narrative, and that's going quite well. But again, we're not delivering. We partner with a PR firm to basically develop this whole entire program. But the most interesting thing again about the programming is not the advice that you're getting from the expert. It's actually the stories that you're hearing from the different folks in the program, which are all of our portfolio companies. And to get back to your point, that was not the goal for the community from the get-go. The goal was just to support founders at the earliest stages. And I think we learned over time that the way in which you do that is through community. And by being able to have the early investment early on. So, as we grow our funds, hopefully, these really incredible founders that want to go start something from scratch, will be able to lead their pre-seed and their seed, so that they don't have to worry and spend what's the time that people spend in LATAM raising money between up until Series A. I think it's like 60% of the time they're fundraising. That's bullshit. Like, how do you solve a super hard problem like giving access to financial services to the middle class for many millions of people when you're fundraising 60% of the time? You can't even build a product if you're doing that. And I think that's like the next that's the next step for us. We started off with smaller checks, and now we're scaling into bigger checks so that we can be leading these investments rather than waiting for another fund to be able to lead.
As you scale larger checks, and obviously your AUM scales, and you raise more capital to deploy, and you had mentioned a second ago that becomes a little bit of a challenge because you end up wanting to go later, but you've been able to stay early. What does the math look like? What is the math that you do when you look at an investment and you look at your equity stake that you need to have in order to kind of justify the classic kind of fund returner? Can you walk us through the math that you do, or maybe the math that you communicate to your LPs?
Yeah. So we're raising a $50 million fund now. I don't think it'll be interesting to look back on this podcast in 10 years, but I don't think our fund size will go above 200 million, if 150 million. And the math around that is, 10% ownership at this point with a $50 million fund. And I think that can easily be closer to 15%, with a slightly bigger fund. And right now we're only putting 30% of our fund into follow-on. so typically most of our money is heavily invested at the earliest stage. And so as we continue to grow our fund size, what I have communicated to LPs, and I think what LPs want to see is that we'll continue to invest more capital into the companies that we've already invested in, instead of investing in more companies, or instead of investing in larger tickets at the very earliest stage. So I think $1 to $2 million is probably the right amount of money that you want to be investing in a company. So if you look at that $1 million today, $50 million fund, they're having to, from a first check investment principle, they're having to 50x. But typically you're trying to get in around $3 to $4 million into like the best performing companies. And so it's up to the founders to really execute and perform. From a $50 million to a $200 million fund, that instead of that $2 to $3 million extra and follow on, going into a company at seed Series A and maybe some in Series B, we'll be able to follow it longer through their journey. But I typically like, and I think for these early stage funds, it makes more sense to be investing a lot of this money at the earliest stage, right as they're starting to figure out product market fit, while the valuations are still low, and you're still able to get, anywhere from a 10x to we've done 100x on one of our investments already in 4 years. So it's like I think that's what you're really going for is these kind of big outsized fund returners.
I was reading a blog post from Fred Wilson today about selling. You've got buying, which is figuring out what you're going to buy and what you shouldn't buy, right? There's a lot of different strategies there. Managing, which is the work that an investor does to manage the investment. That might be doubling down on an existing investment, and that can dramatically impact returns. But then there's selling, and that's all about when to exit an investment and how. It's probably the hardest part of investing. How do you think about exiting, given that you invest so early and the time horizon is longer? If you're coming in, at ideation stage because you're investing in an amazing founder that has founder market fit, your time horizon is much longer. So how do you gauge, when you should be selling versus holding and continuing to invest?
Yeah. So for us, again, we're typically investing most of our money right after we see the company have seeing product market fit. So that could be around the seed, that could be around the A, and it could be at the B. What we typically, I'll give you an example. So we had a portfolio company in our first fund. We invested really at their seed, and they were just seeing some semblance of product market fit. And 6 to 9 months later, they raised a Series A. Now, fund managers make mistakes. We definitely made a mistake of not investing at the Series A. It was like it was our first fund. And I think it was probably our, first time we had seen a follow-on opportunity that quickly. And I think you learn the most from your mistakes. And so I've now, anytime we're seeing a company that's close to product market fit, where we are watching and waiting, looking at data to really truly understand if the next, iteration, or even to invest before the round comes, to get in money as soon as possible once we start to see that data come through. And I think that's what we do as far as fund managers and managing. I think we're pretty good at the buying part in terms of, finding founders all around the world that are really great founders going after really great, market opportunities. On the selling front, we I think we got it right with this same exact company. So we missed it on the follow on, but on the selling side, they had gotten a follow on investment at Series D for $1.5 billion. And at that point, we were 39x marked up, cash on cash. So in our mind, I think as we've gone through this process, and now we're in Fund 3, I think that's our whole entire value add to LPs, which is like, hey, we're going to get you back your principal as fast as possible. And then we're going to be playing with house money to get 5x plus return still. And so our Fund 1 is at 4.8x net TVPI and 97% return. And we did that in Fund 1 because of two things. One, we had a few companies, we got lucky and we had a few companies exit in probably the best time to exit in the last 10 years. And then one company, which is this company that offered a secondary at this $1.5 billion mark. And we're looking at the competition. So what we did as a process, and I would say every single investor should do this as a process when they're going into sell or even follow on, is I had one team basically pitching to buy, and one team we weren't going to buy. But one team pitching to buy to basically stay in, and one team pitching to sell, and had them both create memos. And we took those, both to the investment committee to then determine what we wanted to do. And we eventually said sell because of one, we would have returned most of the principal to investors, which we thought was a really good thing, given it was November of 2021. Competition was high. I think a lot of these companies that you invest in, competition looks so different from the time you invest when like no one's doing it and they're the first mover to a year and change later, where you're starting to see some things and people are starting to raise Series A's, and then 3-4 years later you're raising your Series D, and there's a guy doing the same exact thing that you're doing for charging no money at a Series A. And so we started to see this competition. We also started to see their initial first product completely get eroded. We still believe in the company that they can, continue to, and they've done actually quite well. But the valuation was just so high compared to the revenue, that multiple, we just didn't feel good about it. And so we ended up selling about 85% of our position. And so that process has formed has informed I would say our process that we would go through for the next one, for selling.
It's interesting. It's you've scrutinized the different sides of it. You argue both sides, and then you kind of let that kind of tell you where to go. It's an interesting exercise, I think, internally to kind of flex your kind of brain a little bit and think about. It sounds like you probably timed it pretty well because no one really knew 2022 was going to look like, and so I'm sure that the valuation is off that $1.5 billion mark that it was 2021. I'm guessing.
Yeah, now we do a lot of this. I mean, it not as formal of a process, but that process really informed our whole opinion on how to do follow on in general. Most of the time, follow on is being done by the investor or the partner that did the last round, and bring it to the investment committee. Now we typically have a different partner hop on for the follow on and say, okay, like, would you invest in this? Not having invested any money in the previous round. And so as investors, we typically try to have both that partner that believes in the founders and because they've worked with them and they have that bias, and the partner that has, hopefully no bias and can and creates some really great conversations and creates some really good questions that always come out of that, that lead you to, the best, most informed decision.
Shifting gears a little bit, at K50, you've done a lot of investments, spread out geographically, right? Talk a little bit more about the perspective you see in terms of investing outside of the kind of classic markets. It seems like the last couple of years, the market has opened up. There's more opportunities around the globe. Latin America has been an area that you've doubled down quite a bit. But my understanding is that even in 2018, you started doing some investments in Africa. Talk a little bit more about how you've kind of expanded the range geographically of where you invest, and what's driving the thesis around investing outside of those kind of traditional markets that most investors stick to.
If you were to look at just the number of places that we invested in, some might say we aren't focused. I think the two things for people to understand, both as founders and as investors. First of all, the problems that we're focused on and the themes that we're focused on, they're global issues. They exist in the US, they exist in LATAM, they exist in Africa, they exist in Southeast Asia. Access to credit sucks for anybody that doesn't have a credit score or has bad credit. It's really, really difficult to get access to a bank loan if anyone's ever done it before, as a small business owner or as an individual, and in a growth market or in an emerging market or in a market like the US. So that's one thing. The problems that we're focused on are very similar. There's different things you have to be aware of in terms of regulation, in terms of distribution, in terms of the players. So the execution is different, but the problems are the same. And so we often see models that pop up in China or in Southeast Asia or in Africa that inform our decisions and what we're seeing in the US or in other markets. So that's another piece. I think it works to our advantage. Second thing, when we tell this to founders all the time, we have two different types of checks that we write. One is a community check, which is up to 100K. That's still at the same pre-seed, seed, typically more towards pre-seed, where we'll write a smaller check into a company that we don't feel comfortable leading or co-leading, where we're getting, $1 million checks. They go through the same exact or very similar process, I would say, in terms of how we're looking at the market opportunity. We still need to believe in the team. It's definitely, it's not spray and pray in that sense. It's very much like learning. And we'd like these founders to be a part of our community again, and they get value add they get a lot of value add from being a part of the community. That's where they take our smaller check. And so we have invested in a lot of geographies that we don't have boots on the ground in, right? And so it informs our opinion there. We started investing in Latin America in Fund 1 back in 2016. It was actually one of our first investments was in Brazil. Our very first investment in Fund 1 was in Brazil. I think it was maybe it was investment number 2. They've since exited. We're now actually looking at bringing that founder on as a venture partner, which would be really cool. Is in the education space. And we saw something very special about Latin America that we didn't feel as comfortable about or didn't feel as moved by in the other markets that we were looking at. And I'll share what those are. One, time zone is perfectly aligned with the US. Two, we had a couple of really great LPs and a couple of founders that we had already invested in our Fund 1 and continued on through the different funds. And so slowly but surely we would make, we were investing smaller checks in most of the companies that we invested in, really community checks. But we brought, our partner now, Daniel Vasquez, who I think who's really one of the leading, he created the leading top, family office in Latin America, investing in startups. And so he had been investing in early stage companies in the region at the same time that we started, and was an LP to begin with, and now is a partner. And the idea that there and what we have is our ambitions are to basically do what we did in LATAM. So we have north of 40 companies. We're leading deals. We've done a lot of investments with you guys at Latitude. And our aim is to do this in other markets. And so we're looking at Southeast Asia, parts of India and parts of Africa is like, where do we want to go next? And we'll continue to write, smaller checks in these geographies unless we believe we have a venture partner that could lead the deal. But for the most part, these are community checks. And we really just want to be this global, we started off with a global community. We started our first fund and learned how to invest. And we really want to be a global fund for mission-driven founders with, US is our hub and where that's where the office is. That's where I'm based. But we will bring on partners to be boots on the ground and really be what we call a dual citizen fund, where we have roots in US, but we're building roots in these other geographies where myself and everybody else on the investment committee know about the problems. They know the players. They have and can answer questions that are the tough questions that need to be answered for us to make a great investment, where it's not just like, okay, we have Brian, he's a partner. We never really see him. He brings in a couple of really good deals every now and then. It's actually very, foundational to our firm and fund that we are an international group. So right now, half of our team is Latin American. I would sense that in the future, our team will continue to grow and become this kind of international global melting pot.
How large is the team?
We are 7. We're 4 in the investment team, and then we're 3 operations community platform.
And of the geographic distribution of the investments, what percentage are in Latin America?
Right now, it's a third across the whole entire portfolio of 180.
1/3, and then the other 2/3 US, and then spread out amongst other countries. What does it look like in the remaining 2/3?
To give you a better, I'll just go to the data because I don't have this off the top of my head. So US is 56%. We have a third in LATAM, and then 10% into the what we classify as other emerging markets.
How important is kind of the valuation in that first check when you're coming in at pre-seed and seed? How often do you think about that? How often does the valuation get a little out of hand where you're like, oh, it's too much? Is that sometimes a sign that they're a company that's gonna, I think back to those investments that I passed on that look crazy at the time and they weren't. How do you assess the importance of valuation in that first check?
For a lead check, we are very ownership driven. And we remain super disciplined around valuation. Which is why these community checks come in handy, because we can still invest in companies that are raising at a 35 or 40 or 50 $1 million valuation, pre-seed, seed, second time, third time founder, what have you. In order for us to still be an investor and be able to write a bigger check when valuation and check size align. But I'd say we're very disciplined. We've typically been investing at sub 10.
So sub 10 and around 10% ownership is kind of your target.
Yeah,
so
I mean,
kind of up to $1 million.
5 to 10% is our range. But the good part about being in this horrible market and there's not a lot of venture funding going into growth stage companies is that the valuations have gotten a lot more realistic at the early stage, where in Latam, for instance, like you would raise at sub 5, even as a great founder, for your first round. And we're starting to see, I don't think we're starting to see sub 5, but we're definitely seeing single digits, even for second time founders.
Yeah, back in January, you tweeted about startups reaching, unicorn valuations at their seed round last year, and how that kind of screamed froth. You also mentioned how the laws of physics were back in 2022. What are some signs of a flimsy and a solid valuation that founders should check in their startups?
I think you should be very confident that you can 2 to 3x your valuation for the next round with reasonable multiples. So if you're going into a pre-seed with 0 done and you're raising at 50, can you get to 150 by the seed? And is that going to be based on hype, or is that going to be based on concrete, math and multiples? I think a lot of people, and you'll hear a ton of really great founders say, we were basing our fundraising timeline and strategy on the market and what was happening, with other companies and what VCs were marking these things up to. They were not basing their strategy and timeline on reality. And I think a lot of those founders had big, and we're seeing it even in some of our own portfolio companies, where it was kind of like an "I told you so," where founders were raising at too high valuations and putting themselves in a bad spot for the next round. And we're gonna continue to see pay to plays and companies getting term sheets pulled, and founders losing their business because they were shooting for valuations that were too high. I mean, it should take 10 years to build a real business, any business. And in order to get to $1 billion valuation at the seed, that should like something should be up there. And so we saw 500 plus unicorns get born in 2021, something like that. And I think a lot of those companies will see a revert to the mean. We'll see some fail, and we'll see some come down in valuation. But that doesn't mean that venture or tech are dead. It just means that we're seeing the same thing on the IPO market. Everyone got out of hand. Like, it was not just private investors, it was public investors too. Where the almost half of the companies that IPO'd in 2021 are worth less than half of the amount of money that they raised. That's insane.
2022 has definitely been a year of caution for venture capitalists, right? But you also argued recently that there's still a lot of money wanting to invest in LATAM, and you highlighted favorable demographics, strong digital adoption, and a drive to succeed among founders that is hard to find in Palo Alto or in New York. Could you talk a little bit about that scenario, and especially about this drive to succeed that you see more in Latin America?
Yeah. So I think, let's take it a little out of context, the quote, but what I was trying to convey, I think it was Business Insider. What I was trying to convey to the journalist was the founder that you find in LATAM, first of all, is going out and solving a problem for the masses, right? These are typically really tough problems. They're not sexy. In order to get the investors involved, and in order to really deliver, the returns that all these VCs are looking for, you're taking a large leap of faith. And founders are coming back from Stanford and Harvard and MIT to go and found a company in Latin America because that's where their roots are, and they're solving a problem that's so personal for them that it's that drive to succeed is not success for them to succeed as a founder as much as it is a drive to succeed for the betterment of their country and the region. And that, I think, is so important. People come to Palo Alto from Ukraine, Poland, even Latin America, and they go to build a company that they have zero passion about solving a particular problem for a data company, big data company that exists to serve, the Fortune 500 companies. If you ask them, why they're doing this, it's much more from like, I am doing this because I want to become successful, because then I can then go and do something for my country, my back home, or my family, or whatever it may be. And I want to create a legacy. What you're finding in LATAM is like the company is that legacy. And that's what we try to invest in, all across the world, even in the US. Are you solving a problem that you'd be, whether you made money or not, you'd be so proud of, that you're creating a legacy to really drive value for that many people? That's the most important metric. And it's built into, if you can do that, if you can help multiple million people in any sector, you're most likely you're going to create $1 billion business. And I think that's what's so interesting about LATAM and the founders. All the other stuff in terms of demographics, in terms of where we're at in the cycle, in terms of, creating digital payment rails and e-commerce was the first. And how can we create more companies on top of that, with embedded fintech and with healthcare and with all these other things in terms of like the opportunities that exist. That is so interesting from, in terms of, capital deserves to be there, because there are opportunities that are going to create large financial outcomes. And I think we're at the right point of the cycle where we're similar in the sense of like where China was when, Alipay and WeChat Pay and these things started to exist, where there was infrastructure that started to exist where people could go and start build new companies off of, which I think it's just the right moment for Latin America. But that founder piece, you find that in emerging markets, and it's super, super interesting, because those are the only companies that are, most of the companies that we're investing in and most of the companies that we're seeing are building for, the 99%, which is, our tagline. But we are starting to see some infrastructure level plays that are coming up, like Pomelo, for instance, or Belvo. Again, these companies though are democratizing access to financial services. And I think that's why these guys are ended up, building these companies. And it's that passion, and it's hard to find that in New York and San Francisco.
Well, just kind of wrapping up here, you alluded to the thesis at K50, building a better future for the 99%. And you once wrote that you saw most VC firms focusing only on the 1%, and that kind of you want to be more part of the solution and not part of the problem. Maybe you could share a publicly disclosed investment you made recently that you're excited about, that's very early, that you analyze kind of with that lens, a startup that's fitting such the ambitious goal of your firm.
Cool. Yeah, you always have to have an enemy in any story, right? So we picked the rest of the VC ecosystem to be our enemy, I guess. Maybe not the best path. All in good fun. I think there's a lot of, I do think that there's a lot of really great funds out there. And I think we're seeing it with the fund managers becoming younger and younger, that we are starting to see a revert, we're starting to see more capital going into mission-driven companies. And I'm all for that. So I'll keep egging people on so that more money comes into mission-driven companies. One company that was publicly disclosed, that we invested in, that's serving the 99%, it's perfect fit, is a company called Pandas. They're based in Latin America. They're based in Colombia. Two really great founders, again, both at McKinsey. For some reason, McKinsey, it's not like I have a hard on for ex-consultants, but McKinsey in Spain and McKinsey in Bogota are some of the best talent is coming out of both these offices. I don't know if I just gave away my insight, but these two founders, Marcos and Rio's they met in Spain and McKinsey. Marcos comes to Trenta and learned from Luis. He's actually a really good friend of Luis. Luis convinces him to after he comes to visit him in Bogota, convinces him to come and camp out on his couch, eventually become his roommate and join Trenta. And he says, you know what, I will do that, but I want to go start my own company. So he learned a lot from Trenta, from these small micro entrepreneurs. And for those of you on the pod that don't know Trenta, really great company. My partner is an investor, good friends of Luis. He's building something really great, basically building infrastructure for micro entrepreneurs to accept payments, track their inventory, basically track their whole entire business. If you think about it, like QuickBooks for micro merchants. One of the things that they were trying to build in Trenta was the B2B marketplace for these micro merchants. So as a merchant, you're talking about somebody in Bogota who's selling maybe $4,000 a month, maybe $1,000 a month, maybe $500 a month in goods. They don't have access to a high quality inventory at on demand at good prices. They're typically similar to Frubana, which we saw, similar to Tool, which we saw. There's a ton of different middlemen. And so with Pandas, what they're trying to do and what Marcos saw at Trenta was, let's build a B2B marketplace for these small and micro merchants that gives them access to great goods at good prices. And so they Rio's from China, and Marcos and Rio basically created what we now is almost like the Alibaba for LATAM, where any of these micro merchants can get their goods from China. They're focusing on electronics to begin with, so anything from a hairdryer to headphones, and anything with electronics in it, where they actually import directly from China. And they're also starting to work with these large brands to be the marketplace, where they won't even hold any inventory, and they're working directly with thousands of micro merchants, and they providing them credit, providing them this really incredible marketplace that they can source their inventory through at prices at 20 to 30% below what they were doing before. That, like, and then how does it make sense for the merchant? Like, first of all, they don't get access to credit. This never happens. Secondly, that 20 to 30% price reduction, that goes directly to their bottom line. That means that they can take more money home. That means that they can expand their inventory and potentially expand their business. There's, I mean, micro, no matter if you're in the US or in LATAM or in China, SMBs are the powerhouse of the world. They deliver, most of the GDP. And in LATAM, this is how a lot of people make money. So this is where they're starting. And I'm really excited to see, where they go next, with their product. However, we have a lot of markets to get into. We're just in Colombia right now. And we have a lot of people to buy electronics first, and hopefully we can scale into other products as well, product categories.
That's awesome. I met Marcos in Guatemala. So it was the first time I heard about the company, but it seems like they're building a great business there. Well, thank you for making the time. It was, fun to hang out in person a little bit. Hopefully we, our paths cross again. I'm actually going to be in New York here shortly. So are you in New York these days?
Yeah, I'm in New York, and I'm coming to Bogota next week.
Nice. Well, next week I'll miss you because I'll be in New York next week. But so we're swapping
two
regions,
ships in the night.
But listen, thanks a lot for making the time and for sharing a little bit more about your perspective and excited to continue to collaborate. I think we've got a lot of the fund over at Latitude, which is led by Tommy, Marcial, Nayani, and Bruno. I think we have a lot of investments with you, and so hopefully we can continue to do that.
Yeah, totally. No, and I know Adriel's in contact with all of these guys, and I think we just need to build more connectivity across a firm, especially with like Ariel and Danny, who are more focused on LATAM.
Awesome, man.